All right, welcome back to the deep dive. So, if you're feeling this massive friction in the financial world right now,
Yeah, that tension.
that sense that the market is somehow surging and collapsing at the exact same time, well, you're not wrong. You are absolutely right. Our mission today is to dig into a whole stack of source material to really understand this unstable resilience of the January 2026 market.
And we're going to do it with a guide.
We are. We're going to give you a blueprint for how to navigate this, and it's all guided by the timeless, disciplined strategy of John D. Rockefeller.
And look, before we get into any of that, the asset allocation and all of it, we have to start with the mandatory context from the sources.
The disclaimer.
The disclaimer. This deep dive is, it's strictly for educational and entertainment purposes.
We are not your financial advisors.
We are not. Investing in 2026 carries, frankly, significant and elevated risk. There's global instability, this internal conflict in the U.S. economy.
So do your homework.
You must perform your own due diligence.
Yeah.
That's your best asset right now.
Absolutely. So let's define that paradox. Because on paper, things look, well, spectacular.
Oh, yeah.
The S&P 500 is starting the year near 6,850 points. That's coming off a huge 16% gain in 2025.
By any historic metric, that's a boom.
It's a boom.
Yeah.
But internally, the volatility is just extreme. And this friction, it's not just noise, it's the core signal of where wealth is actually transferring.
And if you want to understand that transfer, you have to understand the core structure of the economy right now.
The-
Our sources are, well, they're definitive on this. We are deep into a K-shaped economic phase.
Okay, so break that down. What does K-shaped actually mean for someone listening right now, practically?
It means prosperity is just radically diverging. So think of the letter K. You have the top arm soaring up.
Right.
That's sectors fueled by, concentrated wealth, infrastructure, defensive industries. They can handle inflation. They can handle high capital costs.
And the bottom arm.
The bottom arm of the K is buckling. It's
Yeah.
buckling under the weight of sustained borrowing costs and, frankly, a consumer wallet that is finally starting to crack.
So the K-shape is really a mechanism for wealth concentration.
That's exactly what it is.
And you can see that playing out, perfectly, in the U.S. indices right now.
Oh, absolutely.
You look at the Dow Jones, that's your upper arm of the K.
Yeah.
It's the legacy strength, right? And it's showing real resilience.
Especially in those heavy industrials.
Yeah. Boeing, Caterpillar,
Yeah.
Goldman Sachs, companies with, pricing power and actual tangible assets.
But then you look at the NASDAQ.
Yeah.
And the NASDAQ, which relies on that future promise of cheap growth capital, is struggling. It's in the middle of a 5-session losing streak right now.
So the money isn't leaving the market.
No, not at all. It's just flowing sideways. It's moving out of that high growth promise and into established value. That's the K-shape in real time.
And the sources point to 3 big macro risks that are just compounding this whole thing. First one, inflation.
It's sticky.
It's sticky. It's holding around 3%. Now, 3% doesn't sound like the end of the world, but why is that number causing so much anxiety?
Because it's just high enough to trigger those fears of a wage price spiral, where workers demand higher wages, companies raise prices, and on and on.
And that means the Fed can't back off.
They can't. They can't declare victory and just start aggressively cutting rates. This sticky inflation is the fuel for the K-shape. It protects the top and it squeezes the bottom.
Right. And risk number 2 is global. Our sources are putting a number on it. A 35% probability of a global recession this year.
That is a huge number. That's a siren call for preparation. It means a big correction isn't just possible. It's statistically probable.
And then finally, the engine of all this short-term choppiness is the Fed itself.
Hmm.
The market expects rate cuts, sure, down to the 3.0, 3.25% range, but the timing is a complete mystery.
And because of that sticky inflation, the Fed is totally unpredictable. Every single meeting is this emotional trigger designed to shake out the fearful investor.
And this isn't just a U.S. story. We're seeing, surprising resilience in Europe. Germany and Spain are leading growth.
Which nobody expected.
Nobody. And then in Asia, you had that little micro rally after Baidu IPO'd its AI chip unit in Hong Kong.
So it all points to the same thing. Capital is on the move, it's looking for opportunity, but it is being absolutely ruthless and selective.
And that brings us to the key concept from the sources. This constant shakeout, this volatility, is actually a massive wealth transfer.
Yes.
Assets are literally shifting from the fearful reactive investor, the one who's, trading headlines,
To the disciplined, proactive one who is actually executing a plan.
That dynamic is what defines 2026. Fear is the most expensive emotion you can have right now.
And that's the perfect way to get into our second section where the capital is actually flowing. Because the biggest story here is the AI fever. It's completely changed.
Oh, so?
The market is demanding proof now, not just promise.
Ah,
The era of just rewarding a tech giant because they say they're spending billions on AI, that's over.
people learned that lesson.
They learned it in the dot-com bubble. You needed the infrastructure, not just the website. Now investors are punishing companies that are burning cash on R&D without showing immediate revenue or, even better, cost efficiencies.
Okay, so let's follow the money. Where is it flowing up in 2026? It sounds like it's going to the foundations.
Precisely. It's all flowing into the AI supply chain, so hardware and infrastructure.
Like NVIDIA, Micron, the obvious ones.
The obvious ones, yes, they're providing the chips, but the deeper play, the one our sources are really highlighting, is power infrastructure.
Okay.
They use a great analogy. They say data centers are the new oil wells.
I like that.
They are incredibly energy-intensive assets. The whole investment thesis has shifted from who writes the best code to who can provide the massive, reliable power to run the code.
And that demand for power immediately creates the next boom, right?
Immediately.
Energy storage, the surge we're seeing in battery tech, and, interestingly, green hydrogen.
Right, which can power these remote data centers. It's all connected to the AI infrastructure boom. If data centers are the oil wells, storage and transmission lines are the new pipelines.
So capital's also looking outside the U.S. now.
It is. It's looking very aggressively outside of the, frankly, expensive U.S. tech sector. Valuations in places like the U.K., certain emerging markets, they're just looking a lot more attractive now. It's capital seeking value. Simple as that.
And we have to mention the maturity of crypto here, Bitcoin.
Yep.
It's hovering in that tight $86,000 to $90,000 range, and it's acting exactly like the sources predicted.
It's digital gold.
It is firmly transitioned into a digital gold asset for institutional portfolios. It's not just a speculative tool anymore, it's an established hedge.
Okay, so that's the flow up. Where do we need to be cautious? Where's the money flowing down?
Definitely in that pure software AI sector.
Mm-hmm.
The companies that are still just talking about AI without showing the payoff, they're being sold off without mercy.
And the consumer.
And the consumer. After years of high interest rates, their debt burden is finally hitting their spending power. So caution is definitely warranted in the luxury and high-end consumer sectors. Even the top arm of the K can only hold so much.
The market is demanding tangible results.
Tangibility and efficiency. So to help you navigate all these shifts, if you're listening on YouTube, hit that subscribe button right now. We are tracking this 2026 volatility week by week.
And maintaining that detached strategic perspective is key.
Which brings us perfectly to the historical blueprint we need to adopt.
Exactly. That idea of discipline, it leads us right into section 3. When you're facing this kind of complexity, the K-shape, sticky inflation, that 35% recession risk, you need an anchor.
Something to stop the emotional reaction.
You need an anchor of emotional detachment. And for us, that anchor is the shark philosophy of John D. Rockefeller.
This is where we turn history into actual strategy. Rockefeller was the absolute master of cold, non-emotional calculation. Let's look at the habits he built. We have to start with the Red Notebook.
The Red Notebook, yeah, it's probably his most famous operational tool.
Yeah.
He carried this small, literal red notebook with him everywhere.
But not for big, grand strategy.
Not at all.
Mm-hmm.
He used it to meticulously jot down every single efficiency, every cost-saving idea he saw, no matter how tiny it was.
So the lesson isn't the notebook itself, it's the habit.
It's the habit. But you might think, isn't that just micromanagement? Doesn't that paralyze you?
That's the question, yeah.
But for him, it wasn't about micromanagement. It was about creating a culture of relentless, non-emotional data collection. For an investor today, your Red Notebook is your portfolio tracking system. You have to know your numbers without emotion. That focus on efficiency is what prepares you for volatility.
And that focus on efficiency led to his big realization about money itself, what our sources call the potato lesson.
This is a foundational story. As a teenager, he worked for 3 days, hard physical labor, for 37 cents a day. He knew the value of work.
Right.
Then he had the insight to loan $50 to a farmer at 7% interest. He earned $3.50 without lifting a finger.
And that was the moment.
That was the light bulb moment. His realization became his life's mantra. He said, "Let the money be my slave, not me the slave of money." And that is the philosophical shift you have to make in 2026.
To let your capital work for you.
Exactly. Move from being a slave to your job or to daily trading and let capital do the work.
It's also wild that he celebrated September 26th, the day he got his first job. more than his own birthday.
He valued the opportunity more than anything.
He valued the chance to get in the game. But the most crucial lesson for surviving 2026 volatility, I think, is his practice of cold silence.
We have to go back to the Panic of 1873.
What is that like?
I mean, the sources describe total financial collapse. His rivals were literally running through the streets selling everything for pennies on the dollar. Complete emotional collapse because the ticker tape was just bleeding out.
Total chaos. The emotional environment must have been toxic.
It was hysteria. And what did Rockefeller do? Total silence. He maintained total silence. He wasn't reacting to the ticker tape. He was listening to the price of real assets. He used the chaos as cover to systematically buy up undervalued railroads, refineries, pipelines, all from desperate rivals who had no cash and no emotional control.
So he didn't just survive the crash.
He used it as his greatest acquisition period in history.
He was watching for the signal, not the noise. And the signal was desperation creating discounts. That cold silence connects directly to what we should be doing in 2026, especially with that 35% recession probability just hanging over us.
And that's where you get his most famous rule: buy when blood is running in the streets.
But that rule is useless if you're not ready.
It's completely useless if you haven't prepared in advance.
Which brings us to Section 4. The strategic war chest.
Exactly. The number one strategic necessity for a disciplined investor right now is building a significant war chest.
Cash reserves.
Cash reserves that you are emotionally prepared to deploy when, not if, that inevitable correction hits. It's the only way to actually execute on that disciplined wealth transfer. When everyone else is panicking, you buy proof, not promise.
So let's tie the assets we talked about earlier to this Rockefeller mindset. He was obsessed with efficiency. He would have hated the burn rate we see in some tech companies.
Absolutely. That's why that AI circular economy, the pure software plays that need constant massive funding without revenue is still such a huge risk.
He would have gravitated toward the tangible, necessary assets.
That's why the money is flowing into the AI supply chain hardware, the energy infrastructure, the massive energy storage plays. There are non-negotiable necessities for this new economy.
You're buying the shovels and the pipelines.
You're buying the shovels and the pipelines, not the speculative mines. It is the safest, most disciplined path to returns in this K-shaped instability because you are buying the underlying utility that everyone else needs.
Discipline over emotion, preparation over reaction. I mean, that is the entire takeaway for January 2026.
It really is.
And if you want our exclusive 2026 asset watch list that's based on these infrastructure and hardware shifts, drop a comment below with the word SHARK.
Thank you for joining us for the deep dive into the unstable resilience of the 2026 market. We'll see you next time.
Like, subscribe and grow with us.